everyone, I'm Jessica.
I'm Tapan, and today we're going to be talking about several different investment styles.
Have you ever thought about how people choose which songs to include on a playlist? We all have different tastes in style, genres, and artists.
Yeah, that's kind of like how people choose to invest their money. Just like there are different music styles, there are also different investment styles.
There are three main approaches to investing: active, passive, and systematic. So let's take a look at each one.
Let's start with active investing.
We like to think that this is similar to having a hockey coach. During a game, the coach will pick and choose which players will be on the ice and which will be off the ice.
With active investing, there's a hands-on investment manager who's continuously buying and selling securities within the portfolio. The managers use their research and expertise to make investment decisions and find market opportunities. But what do managers look for?
Managers may look at a variety of factors and take different approaches to how they actively manage a portfolio. For example, bottom-up managers will start by looking at the bottom line of companies' financial statements to help select which companies to invest in. Top-down managers begin with a broader view of the economy and look at things like GDP growth, inflation, interest rates, and more to inform their investment decisions.
To compensate the manager for their active selection and decision-making skills, these portfolios tend to carry a higher management fee.
Active managers are aiming to outperform the market by generating returns that are better than the index or average market returns.
If we're not looking to beat the index, but simply match its return, another style to investing is taking a passive approach.
Let's compare this to gardeners. They start off by planting a variety of seeds, and then they wait patiently for nature to take its course and for the plants to grow.
Similarly, a passive investor will invest in a range of stocks, typically through an index mutual fund and ETFs, and rely on the market to provide positive returns over the long term.
Investors can choose to fully replicate a market index by owning all of the same holdings in the same proportions. However, some indices have thousands of holdings, so that can be challenging for investors to construct. With so many stocks in an index, it's often easier for investors to look at the subgroups and try to match the index's exposure by economic sector, geography, or risk characteristics.
Now, you may be thinking, once the portfolio is built, what does the investor do? Well, as the index changes over time, the investor will buy and sell holdings to ensure it continuously tracks the index. This is known as rebalancing.
A passive investment style requires less management and decision making, so it typically comes with lower fees compared with actively managed portfolios.
Hey, both of these investment strategies sound very interesting. With their own pros and cons, I wonder if there's a way to combine both strategies together.
There actually is, and this brings us to the third investment style that we want to discuss. Let's take a look at systematic investing.
Systematic investing is often referred to as quantitative investing. It relies on a predefined set of rules and uses advanced computer modeling techniques such as machine learning and artificial intelligence. They take the raw data and transform it into valuable information that's used to make investment decisions.
Once we have this model portfolio, it will undergo rigorous testing by quantitative analysts to ensure that the portfolio can deliver targeted results. But what exactly are these portfolios made up of?
Well, with systematic investing, a portfolio is constructed using equity characteristics referred to as factors. Common factors include size, value, momentum, quality, and many more.
What's great about factor-based portfolios is that multiple factors can be incorporated at one time to offer greater diversification.
Now, let's go back to what I was wondering earlier. Systematic investing can be done both actively and passively. With a more active approach, the investment manager is involved in determining factor allocations within a portfolio. On the other hand, a passive approach will have a greater reliance on computer models built to oversee the portfolio and its rebalancing activities.
Because of its more quantitative nature, portfolios constructed with systematic investing require less managerial oversight and are therefore a lower cost option.
Let's do a quick recap of various investment styles we've learned today.
So to recap, active strategies aim to outperform the returns of a market index through a manager's market and security selection. Of the three investment strategies, an active approach typically carries higher fees.
Passive investing is attractive for investors seeking to follow market returns. Fees associated with its strategies are typically lower than active investing.
Systematic or quantitative investing is more data-driven and reliant on computer modeling for portfolio management. As with passive investing, we also typically see lower fees with this strategy compared with traditional active management.
We hope that after watching this video, you have a better understanding on different investment styles. Make sure to continue following along with our videos and learn more about investing. Have a great day.